the 60-minute chart. Where's my moving average? Let me add the moving average in there. Anyway, the 60-minute chart went sideways in a bull trend, and therefore it's probably a bull flag. Moving average rallied, pull back to the moving average rallied. The double bottom of the moving average, you can call it a triangle, but we're trying to get a bull breakout. But whenever you get a tight range late in a bull trend, there's an increased risk of the bull flag being the final bull flag. And then we try to get a wedge top, 1, 2, 3 here, and we have a bull breakout and a measured move target right there. The bears want the reversal, either at the target or right here, a double top, lower high, major trend reversal. And so this is for the bears, a double top, lower high. This is a 5-minute chart. Bull trend, strong bear breakout, double top, lower high. By going above this high, it slightly reduces the chance that this is going to be a double top, lower high, major trend reversal. But that is definitely a possibility. Let me take a look at the VIX. Still pretty high up. Here's a 4-hour chart. See it's pretty high up above the low, and it usually goes the opposite direction of the E-mini. So when it's up like this, you think the E-mini is down, but instead the E-mini is right near an all-time high. So something is wrong here. The VIX is telling us that the volatility is greater, but we know that. Just look at the swings. Doesn't look like much, but these swings are more than 10 points tall. And one interesting thing about these big swings is if the market is going to get a pullback soon, which it probably will, and you see a big swing like this, here a 30-point sell-off, and it looks big. Sometimes when you're in a buy climax and you get a reversal, what appears to be a big swing, 30 points, turns out to be relatively small. What I'm saying is this can lead to a huge swing, like 100 points down in 2 or 3 days. And then you look back and this will look like nothing, even though right now 30 points is huge. So anyway, that is a risk with that VIX hovering off the low while the E-mini is at the high. So there's a risk of some kind of a surprise, 100-point sell-off within a week, forming within a week, within 2 or 3 days. But because the bulls are in control on the daily, weekly, and monthly charts, even if we were to fall 5% in a week, the bulls would still buy it and we'll still probably get another high. However, that VIX is, I think, interesting and important, and I think it does increase the chance of a crazy sell-off, like 2 or 3 days dropping 100 points. For the bears, they have a double top, lower high on the 60-minute chart, double top, lower high, major trend reversal, and therefore a sell signal. But we're in a trading range. We've been in a trading range now for 4 days. We had an IOI. We went above yesterday's high. That triggers the buy. But 2 bear bars, yesterday being a bear bar closing with a decent-sized bear body, the odds are it's a bad buy setup. When you look at this, you say, on the daily chart over here, you say, wow, what a great-looking bull flag. Or do you say, wait a minute, that's 3 sideways days, 2 bear bars. That's not a very good-looking buy setup. There are probably sellers above the high of that bar. Well, we're right here above the high of that bar, and there are sellers. While we could go higher, it's a bad-looking buy setup, so we probably will not go much higher. So today's probably not going to be a big bull trend day. If it is, then Monday probably will be some kind of a reversal. It's unlikely that this setup is going to lead to a big bull breakout, more likely to be something like this. You get above the high of the bar, but you don't go up, you go sideways to down. Bulls want an opening reversal. They did an important thing. They put a big tail in the bottom of one. They're hoping that this is simply a dip below the support of this high, but more likely we're going to go more sideways to down. What happens if we get above the high of one? Well, one is already 2 ticks above yesterday's high, and that lowers the chance of a double top lower high major trend reversal. If we get above one, that would further reduce the chance of a double top, and it would increase the chances that we could get a trend from the open bull trend. Not likely. Yesterday, trading range day with a lot of big bear bars. Chances are the bulls will need a deeper pullback toward support, like the moving average, if they're going to get a big bull trend day. We're in buy climaxes on the daily and weekly and monthly charts, and we're in a blow off top, and therefore there's always a chance that we could just accelerate up and then collapse. So there is a possibility that this could be a huge trend from the open bull trend. It's just not likely. Are the bulls going to buy above 2, above 1? I would not. Too many bear bars. Top of a 3-day trading range. It's more likely that there'll be sellers up here. They sold off, they sold off, they sold off, and we're in that general area. So more likely we'll sell off again. And even if we do break to a new all-time high, then instead of a double top lower high major trend reversal, traders will look for a higher high major trend reversal. Very strong sell-off late in a bull trend. Usually you get an attempt at a major trend reversal. For the bulls, possibly the low of the day, but the location is terrible. So, let's say 2 closes on its high. I would say 20%, 25% chance, maybe 25% chance 1 will remain the low of the day. Yesterday, 1 was the high of the day, even though it was a doji. Because it was a weak high, that's probably why we had to come back up and test it over here. 3 sideways days increases the chances that today will be another sideways day. Bad buy signal bar on the daily chart. We triggered the buy, but it's a bad buy signal, and therefore unlikely that today will be a big bull trend. Today's the last day of the week, so weekly support and resistance are important. The only 2 weekly prices that are important right now are the high of the week. The bulls want the week to close at or near its high, and the midpoint of the week. The bears would like the week to sell off to below the midpoint, and that would be a sign that they're trying to take control, or at least stop the rally. Breakout above yesterday's high, but only a 2-tick breakout and an immediate pullback. And the bulls are hoping that 2 is a pullback from the breakout above yesterday's high. Usually opening reversals come closer to the moving average, and therefore if we go up here, we probably will have to come back down 10 or 15 bars from now and get closer to the moving average. So not a very good buy setup. Bulls trying to get a good looking bull bar. I would say 25% chance 1 will remain the low of the day. 75% chance it will not. So 75% chance we're going to get below the low of 1 at some point today, probably in the first hour. Bears trying to get a micro double top on the day in addition to the double top here. To sell below 3, the bar probably has to close on its low. And now we have a 3-bar tight trading range in a 4-day trading range. So far, not a good stop entry market. Probably always in long. We gapped up and broke above yesterday's high and then reversed up after a pullback on bar 2. But if 3 closes on its low, I think the bulls will get out below 3 and bears might sell, taking a chance that the 4-day trading range will continue and that we might get a double top lower high major trend reversal. Okay. Bad breakout above yesterday's high, bad breakout above the 2 high, but bad sell signal as well. So slightly more bullish than bearish, but the location is good for the bears and the 2 early bear bodies are good for the bears. This looks like we might have a trading range open and we may have to get closer to the moving average by going sideways to down before we'll decide on the direction of the initial swing. I think this is interesting, right? The location is great for the bears. They want the double top, but they're not getting a good sell signal bar. And the bulls have a IOI, and therefore a breakout mode set up on the daily chart, and they have a bull flag on the 60-minute chart. So the bulls have a buy setup on the higher time frames. What's more important, the higher time frames or the top of the trading range? I think the top of the trading range is more important. We have a 4-day trading range. Not a good sell signal, right? Big tail on the bottom of 3. So traders are waiting for either a better signal up or down or for a strong breakout up or down. Limit order market, good looking bull bar, bar 2, and the bears made money selling above it. We broke above yesterday's high. The bears made money selling at yesterday's high. Most traders should wait. If 3 closed on its low, I think it would have been a reasonable short. I still think we're slightly more bullish than bearish. Big gap up, and we're not reversing down, and the bears are not getting a good sell setup. We have a micro double bottom, micro double top, but a 4-bar tight trading range. The bulls need to get consecutive big bars. I think it's slightly more bullish than bearish. We have a gap up. The higher time frames are all in bull trends, and the 2 best stop entry signal bars today are the buy bars 2 and 4. I am flat. Location good for the bears and early bear bars. A lot of prominent tails, overlap, tight trading range. I want to see a strong breakout before I buy. Or if we pull back to the moving average, maybe buy an opening reversal up. Also, the bears need a decent sell signal bar. This would be a second failed breakout yesterday's high, bar 5, but a lot of traders will only sell if it closes on its low, has a 2 or 3 tick bear body, maybe a 4 tick bear body with a 1 tick tail below. If 5 closes on its low and has a 3 or 4 tick bear body, I think it's an okay swing short. Looking for a test down to yesterday's close in the moving average, possible high of the day. Higher probability, you wait to see 1 or 2 big bear bars and then short. Why would bulls buy right now? Taking a chance that this is going to be a trend from the open bull trend. So they know the probability is low, but when the probability is low, the risk is usually low as well. So some bulls will buy early. Bulls trying here, never got to the moving average and rallied, but did not get very far. Big gap up, rallied, did not get far, had to come back to the moving average. pretty big gap up, had to go sideways to the moving average. Big gap up and rally for about an hour, had to come back to the moving average, went sideways the rest of the day. So where are the big gap up days with early bear bars that become trend from the open bull trends? I'm not seeing any. Here, big gap up, quiet open, it did become a trend from the open bull trend. This is what the bulls would like. But this kind of day happens only once or twice a month. So it's a low probability bet. Big gap up, sideways to the moving average, and then the bulls bought when it got to the average price. Big gap up, early bull bars, came back to the average, moving average. Look at the open of bar 6 above the close of bar 5. As soon as traders saw 5 close above 1, they hit buy the market. And then we got a gap up on 6. Gap up, consecutive bull bars, but not big. And bar 6, so far, hesitation. So always in long, but not a lot of traders willing to buy at the high. So a lot of traders would rather buy a pullback down to the average price. For the bears, they're still trying to get a second failed breakout above yesterday's high. We broke above yesterday's high, reversed down. The reversal failed, the bull trend resumed, and now the bears are trying to get a second sell signal, which would be higher probability. Bull bar, not a lot of traders are going to sell below 6. Still always in long, still a weak rally. A lot of traders are waiting for a better sell or a better buy. All-time high right here, and the 60-minute measured move target is a little bit higher. Another little gap. So as soon as they saw the bull body and the absence of a bear body on 6, some traders just bought the market, and we got a little gap up. Small double top. Measured move up would take us to around the all-time high. Second failed breakout yesterday's high with 3 consecutive bull bars. Lower probability sell. A lot of traders will not take that sell. As for buying below 6, arguing a bad sell, there probably are more buyers than sellers at that 6 low. I don't know if you noticed, but one tick, the bulls who bought the 6 low made money. It bounced 5 ticks, which was enough for them to make a 1-point scalp. It bounced exactly 5 ticks and then sold off. That tells you that more bulls sold than bought up there. Still not a good top. Bulls hope 7 is simply a breakout test of the 1 high, and that we continue to the targets above. Weak rally, but still slightly more bullish than bearish. Ledge up here. So there's a magnet up there, and if we reverse down, we'll probably go above the top of that ledge at some point today. But if we reverse down strongly, then no. But the odds are we got to get above that ledge. And the odds are if we get above it, we'll pull back below the top of the ledge. Second failed breakout. Yesterday's high is below 6, but a bull body. Now we got a double or triple top here, but a bad environment for stop entries. Any reversal down from a new high is a possible high of the day, but this looks like more of a limit order market. You can see gap 10 open, So a lot of traders, as soon as they saw 9 close on its low, they hit sell the market. But this is not a high probability sell yet. We have a ledge top and a ledge bottom. Usually you get a breakout and a reversal of both. So we get a breakout, and usually you get a pullback above the bottom of the ledge, and usually you get a breakout above the ledge and then a pullback below the top. Are we always in short yet? Not yet, but we're becoming. That big tail makes it look like a lot of the bears who sold are scalping. So they're not confident that this is the start of a big bear trend. Getting closer to the moving average, and the bulls want an opening reversal up from the moving average. Now let me turn off the screen and open my PowerPoint. Bulls don't mind a sell-off as long as there's a reversal up from around the moving average. Then they hope for an early low of the day, double bottom. Strong sell-off, but around a 50% pullback and support at the moving average. Good looking bull bar, possible low today. We have that top, the high of the day is a 4-bar ledge, which is a magnet. The bulls have achieved their minimum goal. We have a ledge bottom, 7, 8, 9, 3 bars, same price. Usually you get a breakout and you usually get a pullback. But a lot of limit order trading here, and that lowers the probability for stop order trading. If it's good for the limit order traders, it's bad for the stop order traders. So the probability is not as high as the bulls want, buying above 10, and the risk is big, the bar is big. Still always in long. The bears needed to get some bear bars below 9, did not get them. The bears are hoping 11 is simply a pullback from the breakout below 8, below 9, and that this remains the high of the day. And the bulls want a double bottom, bull flag, a breakout above the neckline, and a measured move up to a new all-time high, and up near the moving, the measured move target on the 60-minute chart. It's slightly more bullish than bearish, but it's really not a trending market. It's a trading range market. Good looking bull bar 2, they made money selling above. Good looking bull bar 4, if they scaled in, they made money selling above. Good looking bull bar 10, they made money selling above. So something's wrong with the bulls. Might be more buyers than sellers, 11 low, but this is really a very difficult market to do anything. Most traders should just wait. Similar to bar 8 yesterday, big bear bar after a sell-off, but they bought the low. I was just looking at time and sales, and a trade just came across with 1,200 contracts at 28.50. Again, you never know if it's sellers or buyers, but since we're higher, you have to assume it was buyers. Most days I never look at time and sales, but sometimes if the market is oscillating or at some key price, I'll take a look out of curiosity, looking to see if some big trade takes place. If some bulls have bought the 10 high, disappointed 11, trying to get out break even, so we get some hesitation here. But we're still always in long, still slightly more bullish than bearish. On this reversal bar 11, I think some bulls bought the close. I bought the close. Some bulls bought the close. thinking that we probably were going to get back to the 10 high because it was a reasonable buy, and we might get up to that top of the ledge. Minimum goal, right? Back to above the 10 high. So, and everybody's scalping. We keep reversing, right? So the market's not going far. Traders know that. So most traders are not willing to hold for swings. This is a limit order scalper's market. Most traders should just wait. I'm at the top of the ledge, so we should try to get above it. Ledge top, ledge bottom. Went above the top, reversed down. Went below the bottom, reversed up. You don't necessarily get a trend reversal, but usually if you break below the bottom of the ledge, you at least test back above its high. If you break above the top of the ledge, you usually test at least a little bit back below the high. Break out above the ledge, pull back a little bit above. Break out below the ledge, pull back above the bottom. Break out below the ledge, pull back above the bottom. When we break out above the top of the ledge, which we just did, within a few bars, we'll probably dip at least one tick below the top of the ledge. Market trying to break to a new all-time high, and 60-minute target is a little bit above that for the measured move. We have a wedge top, 1, 2, 3. Okay bar, not great bar, but okay. We'll probably dip below the top of the ledge at some point in the next several bars, but probably we have to get up to the all-time high. So either we get to the all-time high and then dip, or we dip and then go up. Bulls trying to get consecutive big bull bars, but with all of this trading range trading today, I think the odds are against a big bull trend day. I talked about that earlier today. Consecutive good bull bars, assuming we close up here, the odds are we'll get at least a small second leg up. Can this be a second leg trap? Probably not. Second leg traps in rallies that are second leg traps usually are in trading ranges or bear channels, and this is not a trading range and it's not a bear channel. So if we had a second by the close bar here, right, it's unlikely that we would immediately reverse down. And if we did, it probably would be like, well, this kind of thing. If it immediately reverses down, it probably has to come back up here and get some kind of a double top. If it's like this, a by the close day that reverses down strongly, it's reasonable by the close. It's probably going to get back up there, 10 or 20 bars later. So not a lot of downside risk if 15 closes at or near its high. Even if it closes only at the midpoint of the bar, it's still probably by the close, but obviously weaker. Okay, so it's still by the close, probably buyers below 15, but not as good as bulls want. Bears will probably need at least a micro double top. Big tail on top increases the chances. 16 might be a bear bar, a disappointment bar. 15-minute chart, possible final flag. A bull breakout of a trading range late in a bull trend. 60-minute chart, almost to the target. we do not have to get to the target, but it is a magnet up there. Bears want the reversal. They want this to be the final bull flag, and they want this to be a higher high major trend reversal. Probably not enough bars for a major reversal on the 60-minute chart. Just a 3-bar rally, that's usually not enough. And if you get a reversal down after just 3 bars up, the reversal down is usually minor, which means a trading range. Are we far enough above the ledge for the market to forget about the ledge? I don't think so. I still think we have a magnet at that ledge top. Ledge top, strong breakout, still pulled back, dipping below the top of the ledge before the bull trend could resume. Ledge, strong breakout, 6 bars up, 7 bars up, still eventually worked back to the top of the ledge. For the bears, they're hoping that this is a wedge top with 1 and 6, but most bears will not sell below 16. They'll wait for a micro double top, or they'll wait for 3 or 4 consecutive bear bars and then sell. If 16 closes on or near its low, most bulls are not going to buy the 16 low. They'll wait to see how far down we go. Possible measured move target, room to go. A ledge is always part of a tight trading range, and a tight trading range is always a magnet, and that's why even if you get a strong breakout, the market usually has to pull back into the top of the range by at least 1 tick. Still always in long, probably buyers 15 low, buyers at the top of the ledge, the 8 high. But disappointed by the closed bulls 15, and therefore a lot of those bulls might try to get out break even if it gets back to that 15 close. So if it gets up there and then turns down again, then you have a micro double top, and that would be a higher probability for the bears. Strong bull trend, disappointed bulls. They get out around that 27 close, and then you have a give up bar. The remaining bulls who did not give up, got out here, and the bears sold as well. Minor reversal. Sometimes it becomes major, but if you're in a bull trend and you get a bear bar that's not so big to make it clearly a bear trend, usually you get a couple legs sideways to down. So a surprise bar that is not very big usually leads to a minor reversal. A surprise bar that is very big usually leads to a major reversal. When you get a surprise bar that looks like that, you usually get some kind of a swing down. When you get a surprise bar that looks like that, you expect a minor reversal trading range. I won by 16, but who's going to buy it on a stop above 16? Not a good looking buy. The disappointed bulls from 15 will probably sell out of their longs above 16 if they get an opportunity to do that. So a lot of the bulls, big enough, big up, big down, big confusion. So a lot of the bulls will wait for some kind of a high 2 or a pullback to support. 8 high, the moving average. The bears want a micro double top or 3 or 4 consecutive bear bars. Disappointed bulls got out. A lot of them got out. Bears sold 16 high for a scalp. Still always in long. When you get a buy the close set up in a disappointment bar, and then you see the bulls getting out when it gets back to that close, you sometimes get a give up bar. The bulls who did not get out don't like 18 as it's forming, and they give up, and the result is you suddenly get a bear bar like this. And if we do not get the give up bar, then the bulls are not giving up, and other bulls who see the absence of a give up bar start to buy, and then you end up getting a high 2 bull flag and at least a little bit more up. We might have to get closer to the moving average before the bulls buy again, and we may have to dip below that 8 high. Does not look like a strong bull trend, looks like yesterday. So probably a bull leg in what will end up as a trading range. Usually like to buy the first reversal, the 15 low, but I usually do not buy the second one, the 17 low, even though I think there are buyers there. Now we have a micro double top, and we have a magnet below. Bar 18, multiple of 3, so close of the 15-minute bar. And for the bears, they have a double top, slightly higher high double top, and a good sell signal bar. That follows through here. But big enough 5, I think it's not worth selling below this bar. Still always in long, so still slightly more bullish than bearish, despite the disappointment for the bulls. Bears still trying to get a big bear bar and trying to force the buy the close bulls to give up, and they want to reverse 14, and they want to get a dip back below the top of the ledge. Bulls trying to create a high 2 bull flag, and they want to keep the gap open. If they do, then they'll look for a measured move up. Right now, a breakout test of the 8 high is more likely than a give up bar and a reversal. I would rather have the 19 low touch the 8 high than a 2-tick gap. 2-tick gap increases the chances that we have to get closer, and that lowers the probability for the bulls buying above 19. Here, 29 low hit the 14 high and overlapped 21 by 1 tick, so a slight negative gap. The bulls were able to get at least a scalp up. Bears trying to get the give up. So do we get a reversal up from the 8 high, maybe 1 tick below the 8 high, or do the bears get a big bear bar, which would represent the bulls giving up? Minimum goal, right, was 1 tick below the 8 high. And then from here, the bears want a reversal down, and the bulls want a bull flag, a breakout test of the 8 high. You can see they bought the 8 high, 50% pullback, but not a good buy signal bar. The bulls are hoping that it's like 69.70 yesterday, that even with a bad signal bar, you can get a strong rally. Tight trading range here, tight trading range here. Buying with the stop above 19. I think not a very good buy. Still always in long. And now a tighter stop for the bulls to 20 low, but tight trading range. So we may go sideways for another bar or two. We may pull back, like above 10, we pulled back. Bulls did not get above a bull bar 20. So if the always in bulls get out below 18, which is reasonable, they did not yet buy again. They want to buy above a decent bull bar, like 20. And for the bears, they're hoping 20 is simply a pullback from the 19 breakout. Second failed breakout yesterday's high. 19 is the entry bar. They're hoping 20 is simply a pullback. I still think it's always in long, so I still think it's slightly more bullish than bearish, even though tight trading range here, tight trading range here, we're still above the moving average. And the biggest move of the day was a bull breakout. Bulls trying to get a better buy signal bar. And the bears want the breakout below 20. Not good trading, bulls or bears. Probability is not all that high. And most of it has been limit order trading. Not a lot of good stop order trading. Buying above 1, 2, or 4, you probably get out below 8. Selling below 8, you probably get out above 10. Buying above 10, you probably get out below 18. And the bulls are waiting for another bull bar to buy again. That's getting above a bull bar 20, but not a strong buy, top of a tight trading range. When it went below 21 and paused, I placed a limit order to buy, and I've already scalped out. Tight trading range, I want to buy low, below things, or as things are turning up from below things, and sell high above things, or as things are turning down, and I only want to scalp. Usually when the range is this tight, I stop trading, so I may wait to see what we get here, wait for some kind of a breakout. Still always in long, right, but not strongly bullish. Might go up for a third push to some kind of a wedge top. Strong enough rally, second leg up likely. So far the second leg up is weak, but it could accelerate at any time. We had that yesterday, a weak rally, and it accelerated, did not get far. Weak rally, accelerated, did not get far. We have the 60-minute measured move target about 5 points above where we are. I do not know if we'll get there today. Wedge, 3 pushes up, 1, 2, 3. So it's a wedge lower high, but not a major reversal because the pattern does not have enough bars. Only about 4 or 5 bars down, 5 or 6 bars up, probably a minor reversal in a trading range instead of the start of a bear trend. You can see nobody wants to buy high. It's a tight trading range, a weak breakout in an overbought market at the top of a 4-day trading range. Nobody wants to buy up here. This is a sell zone. But we don't yet have a good sell. The bears need to reverse 13, 14, 15, so they need 2 or 3 bear bars about the same size as these bull bars. If they get it, then the market will be always in short. If they do not get it, it'll still be always in long, and the odds will still favor higher prices. We've been above the moving average for 26 bars. Probably buyers the first time we get down to the moving average. Daily chart, an IOI, but a bear bar yesterday. Breakout mode, but a bad buy signal bar. And the result is the rally today is weak. I haven't taken any trades in the past few bars. The range is too tight, and that makes it difficult to structure a profitable trade. Plus, it's not fun. So, I want to trade for fun and profit. And if the fun part is not there, I usually wait. The profit part is also difficult in here. Bear is trying for a give-up bar, and the bulls will probably buy around the 20 low, the bottom of the trading range, and the moving average. I said that for the bulls, 20, once it reversed up, gave them a tighter stop. So a lot of bulls will put their stop below 20. And that's especially true since it's a breakout test. It tested support and reversed up. Traders, the bulls do not want to see it break below that 20 low. If it does, the odds favor a measured move down. So the bulls are buying here again at the 8 high. They're trying to prevent the market from falling below that 20 low. 20 low was a test of a breakout point. And that should remain as the low if this is going to be a bull trend. I don't think it's going to be a bull trend, but if it's going to be a bull trend, the bulls do not want a second test, and they certainly don't want a second test that falls below the first test. So a lot of the bulls will stop out below 20, and some bears might enter with a stop 1 tick below 20, but tight trading range, usually selling with a stop far below the high is not a very high probability trade. But we're getting a lot of bear bars for a bull trend. So right now I think we're probably going to break below 20, and we're probably going to trade down. Can you buy the 20 low? I would not do that. That was a breakout test, and if this is a bull trend, it should not fall below that 20 low. It's a major higher low. If it falls below the 20 low, then no longer a bull trend. Right now it's either a bull trend or a trading range. If it falls below 20, then it's either a bear trend or a trading range. It could quickly become a bull trend again, but as soon as it gets 1 tick below 20, it's either a trading range or a bear trend. The bulls would need a reversal back up to convert it back into a bull trend. Is this enough of a give-up bar like 35 yesterday to make the market sideways to down? I think it probably is, and therefore I would not buy above 30. Maybe if it was a huge bull bar closing on its high, but right now I think we're going lower, or at least sideways and then lower. That is a swing buy. I don't know that the probability is high enough for a scalp, but it's a double bottom breakout test. Sometimes you get perfect double bottom breakout tests. But as I said, if it falls below the 20 low, we're probably going to get a measured move down. This is not good trading. We've been in a tight range for 15 bars. But like I said, if it gets below that low, we're probably going back down to the open of the day. Swing buy, but not a great swing buy because we're in a tight trading range and a weak bull trend. 20 gap bar buy, 20 bars with gaps below the low and the moving average. It means bulls have been buying above the average price. They now finally get a chance to buy at the average price, a discount from what they've been doing. So a lot of bulls will take it, but with a tight trading range, a lot of traders are waiting to see if the range gets bigger. It's a sell below 29. If 31 closes on its low, some bears will sell below 31, looking at 29 as a breakout of a bull channel or whatever you want to call it, a double top, a lower high. But something's wrong here with the bulls. Way too many bear bars, way too much selling pressure. Trading range, can you buy at the 29 low, betting on a failed bear breakout? Normally I like to do that, but this is a special case. We have a breakout test, and anytime you get a breakout test that reverses up that low, it becomes a major higher low, even though we did not go to a new high. It should not fall below that low a second time. So this is not your typical tight trading range by the low setup. The probability shifts in favor of the bears if we get below 20. Tight trading range, traders are looking for a measured move up or down. Bulls are willing to buy above 30, stop below 29, risking 2 points, looking for a measured move up from their entry price that would make about 4 points. And therefore, the math is okay. So even if you lose 60% of the time, it's still a profitable strategy. I had a stop to sell one tick below 29 and did not get filled. So I'm going to pull my order. I still want to sell below 32 if it's a bear bar closing on its low and it does not get too big. It's pretty much breakout mode bar 31. If we get above it, we're probably going up. If we get below it, we'll probably break below 29. I am currently flat, and I'm willing to buy and I'm willing to sell. But I don't like to trade when the range is too tight. Still slightly more bullish than bearish, but not very bullish because we would not be in a tight trading range for 20 bars. Nobody's willing to buy above bars, and nobody's willing to sell at the bottom of the range. And some traders are buying with limit orders near the bottom of the range and selling with limit orders near the top. I am flat. It's slightly more bullish than bearish, but not much. Every bar that gets added to this makes the probability closer and closer to 50-50 bulls and bears. Bulls are trying to get a resumption of the bull trend. The bears want a double top with 25. Whenever you have a tight trading range that has a lower high, this high is below that high, and then you get a double top within the tight trading range, you have about a 40% chance of a reversal down, major trend reversal. The bears need a double top and they need a good sell signal bar. If they get that, they have a 40% chance of a swing down, a double top, lower high, major trend reversal. Double top, lower high in a tight trading range, traders will sell a reversal down. strong bull trend. This high is slightly below that high, and we have a double top. Traders will sell maybe below that bear bar, and at that point, 40% chance of a swing down. And usually the second leg down is bigger than the first. Tight trading range, rally tight trading range like today, lower high and a double top, a bear bar. Traders will either sell there or they'll wait for consecutive bear bars, and then it's clearly always in short, and then they sell looking for a swing down. Here we have a tight trading range at a new high. It's not a lower high. This is a daily chart, but it still resulted in a couple legs down, 1, 2, or 1, 2, or 2. Here's a perfect double top, tight trading range. You can call it a triple top. A couple legs sideways to down. Today is more like this, weak rally, tight trading range, possibly a double top. The bears need a good sell signal bar, 36, but they should not have allowed 34, 35 to look that way. And because the bulls have a pair of decent bull bars, the bears might need a micro double top. So not simply 36, they may have to get a small double top, 37 with 35, before traders will sell. 35, even though it's not big, it's big enough so that right now it's more likely buyers below 36. 3 consecutive bull bars. For the bulls, it's a resumption of the bull trend. The bears want the double top, lower high, major trend reversal. It's a strong enough resumption, even though it's very weak, it's strong enough so that probably buyers below 36 and the bears will probably need at least a micro double top. More likely, 37 is a bull flag, a pullback and a bull trend, than the start of a bear trend, a trend reversal. But everything is tiny, right? So it's not good trading. Strong enough breakout, probably at least a small second leg up. $60-minute chart, getting close to the magnet. We don't have to stop there. We could break strongly above it, but it's not likely. Look at the bars on the 60-minute chart. Gap up, doji, bull bar, doji, bull bar. Probably bad follow through next hour as well. Can you sell below 41 for an exhaustion gap? 3 pushes up, 6, 15, I would not. It's a big enough breakout to be a little bit of a surprise. And if you have a surprise, you're probably going to get at least a little follow through. Not a good looking high one, but this might end up being a measuring gap. It does not look likely, but, the market was trying to top out and we're breaking to the upside. So I don't think we'll get there, but the daily, weekly, and monthly charts are all in very strong bull trends. So there's a small possibility that we'll just keep going up and up and up all day. The reason I say small probability is because we spent so much of the day in tight trading ranges. So it's unlikely that this is going to continue as a small pullback bull trend. It's becoming a small pullback bull trend, so spike pullback channel. Traders are buying at the market, buying for any reason, because the odds are the first reversal down will not get very far. Is it going to go much higher than this? Well, look where we are. 2860.75, and that's exactly where we are. So we're at the magnet. we do not have to stop there, but it's an obvious, well, I don't know if it's obvious, but it's a magnet. Looks like a lot of the computers took profits at that measured move target. It's a small pullback bull trend, especially since bar 30, and that makes it a bad stop entry short. Some bears sold with limit orders above the high 244, others sold at the measured move target. But in general, when the pullbacks are as small as these are, it's usually better not to sell until you see bears making money selling, and they're barely making money selling. If I zoom in close, you can see the bears who sold the 42 high, not a good looking buy, did not make money. Right? Bears who sold the breakout above, well, actually, this pulled back below 43. So the bears who sold the 43 high and added on higher made money. So this is the first time the bears are making some money. But still a small pullback bull trend. And in general, very difficult to make money selling, especially with stops, for example, below 47. High climax, but tiny and still a small pullback bull trend. So not worth shorting. Might go sideways a little bit, right? Big up, big down, small version of it. So it might go sideways, maybe sideways to down to the moving average again. But I'm not sure that it's worth selling the 48 high. After the buy climax, some of the bulls might wait for a double bottom around 42 and at the moving average. Limit order bears finally made money. They sold the 47 high 1 point higher, but I'm still not. I still think selling is not a very good thing to do. I think it's better to just buy anything. When you get these small pullback bull trends, usually after 11 o'clock, there's a deeper pullback. I'm not expecting that, but even if you get it, usually you get a resumption of the trend. You look at the biggest pullback of the trend began here. The small pullback bull trend began here. And later in the day, after 11 o'clock, this is around 12:30, you usually get a pullback that is 50 to 100% bigger. This is 100% bigger. That's the size of that. And this is twice it, so this is 100%. This pullback was more than twice. Okay, small pullback bull trend began here. We had a breakout here, small pullback bull trend here. This was the biggest pullback, and this pullback was about twice as big, but it did not reverse into a bear trend. I call these things end of day bear traps. You get them in other types of days as well. This is an example in a small pullback bull trend. A bull trend, the bears tried to get a breakout, bad follow through, and they got trapped. The market continued up. Tried to sell off late in the day, 20 gap bar buy, bull trend resumed. So a bear trap, bears trying to get a reversal. Instead, the bull trend resumed. Here's a small, brief bear trap. The bears tried to get a reversal. Small pullback bull trend. The odds are against the reversal. Probably going to be a bull flag, and the bull trend resumed. This is a bear trap in our trading range day. That's not like today. But 11 o'clock. We're around 11 o'clock now. And we could pull back, but if we do, chances are it'll be a bull flag. This is similar to that day. Over here that just rallied relentlessly all day. Some profit taking at the end of the day, but small pullback bull trend. Will today do this? Sometimes you get days, a lot of times days copy what other days do, but usually there's something different. So today we'll probably do something different. I think this day was stronger than today. Today's strong as well, but this I think was stronger. Less hesitation, more bull bars. This has more dojis, more bear bars, so it's not as strong. I don't know if my mic was on. I just compared today to that day last week. Small pullback bull trend. I think this day had far more bull bodies closing near their highs than what we have today. But even then, they still got some profit taking at the end of the day, which we'll probably get today. Today we have more small bars, more bear bars, so not as strong as that day last week. This is that day last week, 15-minute chart, a lot of bull bars. Here, it's just more tails, small bars. Here, 5 consecutive decent bull bars. Here, 1 or 2, and then dojis. So again, this is, I think, not as strong as what we had last week. But it's still difficult to make money trying to short, so it's probably better to wait before selling. 60-minute chart, pausing at the measured move target. We had a wedge top, a bull breakout. There's a gap this low, that high, and we're right at the measured move target, a little bit above. Five-tick trap for the bears who try to stop entry short after the II. Very difficult to make money with stop orders when the market's in a small pullback bull trend. Starting profit taking here. So this might be the first stop entry sell. If it gets too big, probably better not to sell with a stop. Limit order bears making money. We had a 5-tick trap here, but looks like we're entering a tight trading range. And the limit order bears who sold this high probably will make money. Bulls want this to continue up, but we're starting to get doji bars, so we might be doing this again. Now, what about the stop entry short below 59? It's probably a minor reversal, and probably buyers around the moving average. And so you're stuck with the problem that you often have, where the risk is big relative to the reward. It's only a scalp. It's not a major reversal. A small pullback bull trend, the first reversal, minor. You can say this is the first reversal, but it's a 1-bar pullback, so it's still part of the small pullback bull trend. First reversal down, minor. So it's not a swing. Traders selling this are therefore scalping. There's room to the moving average. The math is not great for a stop entry. The limit order bears have not yet made money above 54, but they probably will. We'll probably fall the extra tick to trigger the sell, and then we'll see if there are buyers below or sellers below. Chances are 11:30 in the day, we only have an hour and a half left of the week. Chances are we'll try to get some profit taking. Bulls are trying to do the same as they did below 55, but I think that this is a second attempt, so I think the probability is probably better for the bears here than it was here. The bulls want to double bottom 56, 60, but a lot of bulls will not buy above 60. We're in a tight trading range. We have a decent bear bar, a second entry short, and we still have room to the moving average, which is a magnet, and we haven't hit the moving average in over 20 bars. 20 gap bar bulls. We had a pair of bear bars here, and it took a few bars, and the bulls bought again. Some bulls will buy with a limit order at the moving average at the 56 low, betting that this is a minor reversal. We have a spike pullback channel, and the bears like to get down to the bottom of the channel. Usually there's a pause around halfway down, which is where we are now, channel, pausing halfway down. The odds favor resumption up slightly, but if we start to go sideways here, it starts to become 50-50, and we may come back down to the start of the channel. But small pullback bull trend, the odds are this is a minor reversal, which means bull flag or trading range. We have big up, big down, big confusion, probably sideways here, so probably a trading range for the next several bars. Can you buy above 61? Let's say it looks like this. Let's say it's a great looking bull bar. We have micro double bottom 60, 20 gap bar buy, double bottom 56, small pullback bull trend. I still would not buy. 60 is big enough so that I think we may go sideways for a second bar. I'm going to open up my examples folder again, file again. End of day, profit take. This is what the bulls want. Despite a strong sell-off, they bought it and we closed at the high. This is what they're hoping we'll get today. I think we'll probably have to go sideways for 5 or 10 bars like this first. That's assuming we go up. Can you buy above 61? Put a stop below 61. And I don't think you can do it for a scalp, but you can do it for a swing. Most likely, this is down enough, and we have enough two-sided trading here so that we're probably going to go sideways. Can you sell the 61 high? I would not. If you're selling in a small pullback bull trend day until it clearly becomes bearish, I think you can only sell at new highs. I would not buy this. I think there will be sellers above. And you can say, well, if you think there are going to be sellers above, why not sell above? Because I need more than probability. I need risk and reward. Let's say I sell above and put a stop up here. So I'm risking 2 points. What am I trying to make? 1 point, maybe. So I'm risking 2 points to make 1 point. And if let's say I'm 60% certain there are sellers above, that's not enough certainty to take that trade. If the risk is twice the reward, you have to be more than 60% certain to make the trade worthwhile. Another stop entry sell. The bulls are hoping 61, 62 is a strong enough breakout, like here, 34, 35, 36, so that the reversal attempt becomes a pullback and the bull trend continues. I don't think the bulls want the market to fall below 63. We're starting to enter a tight trading range. I don't know that it's worth the bears selling, but it's a bad bar for the bulls. If I were doing anything, I would buy at the market, as soon as 63 closed and put a stop 1 tick below its low. Not enough bars for a major reversal, and therefore, if you're selling below 63, you're scalping, and then you have that same problem. If you're trying to make, let's say, 1 point, you're risking 2 points to make 1 point, and you need very high probability, and this is not high enough probability for that. Micro double top, so better for the bears that were micro double top and a double top, but still not a very good stop entry trade. This reminds me of what we had earlier in the day over here, where it's easier to make money with limit orders. Bulls are buying, right? They even bought the 64, 63 low. And bears might sell here. Bears made money selling above 47, above 54, and they'll probably make money selling up here. It's not likely that we'll get a measuring gap this late in the day. Am I eager to sell? No, it's a small pullback bull trend that is getting bigger pullbacks. It's starting to evolve into a trading range. But if I were doing something right here, I certainly would not buy. I want to buy. It's starting to evolve into a trading range, so I want to buy below things and closer to the moving average. And if I were selling, I would be selling right here. And I did not sell this. This is why I'm hesitant to sell when the market's in a small pullback bull trend, because it's the strongest type of bull trend, and it often goes much further than what seems reasonable. Remember when we had 40? I said at the time that I did not think we would reach a measured move, but if we might, well, it looks like we're going to. So I certainly would not sell here when this is a potential measuring gap that would take us here. Can you sell with a limit order right there? Well, it's another one of those things where the math is good. The probability is you make money, but you need more than probability. You need risk and reward, and the risk is big. If you're selling a buy climax, you have to use a stop at least as wide as the two bodies, which would be up here. And is that worth the reward? You know, if you look at the probability, better than 50-50 chance you make money, maybe 60% chance you make money selling that red line. But when I say make money, I'm talking about making a 1-point scalp. But if you have to risk 3 points to make 1 point and you have a 60% probability, it's a losing strategy. Strong enough breakout, the bears will probably need at least a micro double top. Today looks like this kind of a thing. The market went up to the measured move. The bears tried to get a bear trap. Still a lot of time left in the day. And this is the strongest breakout in more than 20 bars, since maybe bar 14. 2 or 3 bar breakout, even stronger than this. So probably climactic, but that does not mean you can structure a good short. It's still buy the close, although I would not be buying up here. I'd look to buy a pullback. $60-minute chart, ignoring the measured move, I'll get rid of that. Still possible final flag, but no reversal yet. 6 hours of rally today. Daily chart, blow off top, but no reversal yet. And even when we get the reversal, it'll be minor, a trading range. Buy the close, but I'm going to wait. I'm not going to buy it. This is too far, too fast at the end of the trend. So too much risk of a reversal. To me, you can't, I'm not going to short. Maybe a few bars from now I might consider it, but this is just up too strongly. too extreme. So probably we'll get a pause or a little pullback. I would not buy it unless we had at least a couple legs sideways to down. Whenever you get the strongest breakout, and this is extremely strong, coming late in a trend, usually the trend will not have much more left. Sometimes you'll get a second leg up and then a pullback, but this is probably the last rally of the day. What about a stop order short? I would not do it. What about buying the 71 low? I would not do that either. What about selling the market and scaling in higher using the breakout for your stop up here? Well, the math is okay, but you might run out of time because we only have a half hour or so left in the day. So that's not good either. It's similar to this, except we're a little bit earlier in the day. So I think we'll get more of a pullback. But it's hard to short because the risk is great and the chance of a big reversal down is small without at least some kind of a micro double top. By the closed bulls, they get out 4 ticks below any bar, so 4 ticks below 71, or 1 tick below a bear bar, especially a bear bar that has at least a 2 or 3 tick bear body. This is just up too much, so I'm trapped out. I did not buy 71, and I don't see a good way to sell. Sell the 72 high. I don't know. We're running out of time. So, limit order shorts are hard. 15-minute chart, you can see the best looking bull bar since over here. About 20 bars. Probable exhaustive buy climax. But that simply means end of the bull trend. It doesn't mean conversion into a bear trend. By the close end of the day. Try to find. This is the risk of by the close at the end of the day. You can get a shockingly huge sell-off, erasing all of the gains. Another version of it. Extremely strong bull trend. By the close began at 12:05. Today, the rally began at 12:05. So there's a risk of an incredibly sharp reversal. And unless you're very quick to make decisions, you can get trapped. And anyone who bought up here ended up losing money. This is a good example of my rule. If it's by the close end of the day, you get out 1 tick below a decent bear bar. And if you get a really good sell bar like that, a lot of bears will sell looking for a scalp down, two points down maybe. Anyway, this is the risk for today. Bulls trying to get another pullback like 61, like 65. Sometimes you get an outside up bar. If the bear bar 72 has only a 1 tick, 2 tick bear body, and the market goes below it, sometimes you get more buyers than sellers below, and you quickly go outside up. But again, I would not be buying here. And for the bears, they're not getting a good sell setup. We had one of those outside up bars right here. So by the close end of the day, doji bar, and it triggered and went one tick below, so a lot of the bulls gave up, and then we got a big outside up bar and closed a little bit higher, not a lot higher. Possible small final flag, but downside risk is small. There's always that increased risk of a very sharp reversal at the end of the day when the rally is as climactic as this, but the risk is small. Stop order bulls, if they bought above 71, they got their 6 ticks. If they bought above 72, they got their 1 point. If they bought above the bull bar 73, they have a 5-tick trap. Remember I said some bears might scale in, but they would put a stop based upon the height of the buy climax. That means their stop is way up there. I would not do it because this is so extreme. We're in a blow off top. We can go up a long way and fast. However, the bears who did sell for any reason, and if they put their stop up here, their stop a tick or two above it, they probably will make money. Although, for me to be thinking about selling when the market's doing this, I can't do it. I wouldn't do it. Parabolic wedge since bar 60, 1 pullback, 2 pullback, 3. This was strong enough to have a second leg up, which it has. This might be strong enough for one more leg up, but I think this is probably going to be the end of it. And if we get a reversal, the odds are, it's just really hard to structure a good short. If, let's say 75 is a big bear bar closing on its low, let's say it looks like 63, then you could probably sell because most bulls would get out and not buy again for the rest of the day. So the bears might be able to get a scalp if they get a very strong looking 75. But most traders, I think, should just wait until Monday. While it's possible that the bears can get a sell up, this is not behaving the way it typically does when you're going to get a climactic sell up at the end of the day. You've got a small bar with prominent tails, another doji here. So instead of the market behaving like an Aurora band that's stretched too much, it doesn't look stretched too much. We're spending 3 bars sideways here. That reduces the chances of a sharp sell-off at the end of the day, increases the chances that we just go sideways into the end of the day. I think I'm going to scroll back to December. I thought sometime in December we had, this is it. Same kind of finish, bull trend, and closing up near the high. The next day had followed through buying, but whenever you have a climactic day, usually 75% chance you're going to have at least a couple hours of sideways trading that begins around the second hour. So we might get some follow through buying on Monday, but we'll probably have at least a couple hours of sideways trading on Monday. Second attempt at a top 15-minute chart, the bulls had a big bar here. Very often you get a second big bar and then you get the pullback, which is what we're probably going to be doing here, either into the close or into or early Monday. The biggest buy climax of the day, often you get a second big buy climax, but if you get that second one, that's usually the end of the trend. That doesn't help us, it's the end of the day and no good sell setup. I have this drawn in approximately where theoretically the bears would put their stop above that bar. I said I would not take that short, but that's theoretically where the bears would have their stop just above that measured move based upon these bodies, and they'd be stopped out here. Let me take a look at the volume, bar 78, about 100,000 contracts. So that's a decent amount of volume. incredible day, really amazing day. I did not do anything here. I just let it go and I missed it. I wanted to short, but it was too strong to short, and I was concerned about the risk of a big reversal. At the end of the day, I tend to get tired nowadays, not 20 years ago, 30 years ago, but now I tend to get tired at the end of the day, so I have to be more careful. But it was still buy the close here, and if bulls get out below 70 and 71, theoretically, if they're trading always in, they get long again above 73. Monthly chart, we have, I think, 3 trading days left of the month, and this is a huge month, certainly the biggest month of last year, right, and comparable to this month, and we're accelerating up out of a bull microchannel. This is extremely climactic, and therefore it's probably not going a lot higher without pulling back, but that does not mean you can make money shorting it. The risk to the bulls, probably a test of the bottom of this month, which would be the close of last year. But this is comparable to the 5-minute chart today, right? Just because it's climactic does not mean you can make money selling. It can become even more climactic. Weekly chart, I forgot the number of weeks. I think it's about 65 or 66 weeks since we've touched the moving average. In August, we got to within a couple ticks, but did not touch it. And this is the longest stretch in the history of the E-mini, which is about 20 years, and the history of the S&P, which is about 95 years, 96 years, and the history of the Dow Jones Industrial Average, which is about 120 some odd years. But there's no sign of a top. And even when it does start to reverse, it's probably going to take at least several weeks to get down to the average price because it's so far above. This is 4 weeks here, right? So to get back down there, it probably will take at least 4 weeks. And even then, any reversal, bulls are going to buy. They're buying relentlessly up here. If they get any kind of a pullback, they'll buy it as well. Daily chart, no sign of a top other than a series of buy climaxes here, and then here, and then here, and then here. That increases the chances of a couple legs sideways to down, but we don't have a top yet, and the pullbacks are just brief. Here, just a little bit below the prior day's low, same with here. Makes it very difficult to make money selling. Bulls will buy the first pullback. We've been above the moving average now since back here. I don't know how many bars that is, but probably 40 or 50 bars. So bulls will be happy to buy at the average price when they get a chance. Similar to this, above the moving average for a lot of bars. When there's finally a discount and it gets marked down to the average price, bulls will buy. We started out with a bear bar and gap up in a bear bar, and basically a sideways market here and then here. And if the market looks like it's forming a bull leg in what will become a trading range day, you always have to pay attention to 9:30, 10 o'clock or so, because instead of reversing into a bear leg in the trading range, sometimes you get a breakout and the day becomes a small pullback bull trend day. And this is an example of it. So it looks like a bull leg in a trading range, and then we started to break out. You got to be thinking that it might be a small pullback bull trend day, which it was here. And this might have been the end of it. We tried to pull back and enter a trading range. We got about a 50% pullback, tested the moving average, bounced up. The bears tried to top again, and then we got to buy the close finish into the end of the day. For stop entries today, for the first 2 hours, 2.5 hours, it was, I think, really bad stop entry trading. Buying above 2, well, it proved to be the low of the day. 1 was the low of the day, but 2 is the first buy signal. Above 2, above 4, neither one very good. Above 10, not all that good. Above 12, not all that good. Above 20, above 22, you're buying at the top, and the market has a lot of two-sided trading, so it's a swing only. And then above 30 or 34, a little bit better, you're buying a pullback to the moving average. And then we got 40, and you look at that and you say, that shouldn't have happened. This is supposed to be a bull leg in a trading range day, and now we're breaking out, and the pullbacks for the past 10 bars are small, and we have a possible gap, 42 low and 15 high, so therefore a possible small pullback bull trend day. We got some profit taking here, bar 60, and it turned into a bear trap. Most of the time when you get a small pullback bull trend day and you get a sell-off around 11 o'clock, 12 o'clock, it's a bear trap. And sometimes it's a very sharp sell-off, but usually it does not get down very far. Rarely, this is rare to get this much of a rally after a bear trap and a fairly weak small pullback bull trend day, but we did go up relentlessly, and we covered a lot of points in the final hour, although I did not trade it. I thought maybe the single most interesting thing was bar 29. Bar 20 was a breakout test. We had a ledge top, so it's a magnet. We had a ledge bottom, a magnet. We broke below the ledge bottom. Usually you get at least one tick above the bottom of the ledge. We had a ledge top. Usually you get a breakout and a pullback that falls at least one tick below the top of the ledge, which we did. And we reversed up above 20, but a wedge, 1, 2, 3, and we reversed down on 29, and I thought that was bad. 20 has to be a major high or low. It's a breakout test of the ledge, and we might be turning into a bull trend. The market should not allow a second test of that breakout point with the second test falling below the first. So I said at the time that if 29 fell below 20, we were probably going to fall for a measured move down. And that the location is good for the bulls, but the overall pattern is not all that good. And then 30 was a surprise bar, closing on its high at the moving average. Okay swing. I did not think the probability was high enough for a scalp, and it just kept going up and up and up all day. A lot of the stop entry buys were hard, and that's always the case with a small pullback bull trend because the pullbacks are small, and that means if you're entering with a stop, you're entering at the top. So buying above 38, buying above 45, you're buying at the top. And small pullback bull trend days typically don't look all that bullish. They tend to have a lot of bear bars, small bars, sideways bars, yet the pullbacks are small and the trend keeps going up. This is unusual in a small pullback bull trend day, especially late in the day, but we're in a blow-off top right now on the daily, weekly, and monthly charts. And it can accelerate upward very dramatically before it ever begins to pull back. And it looks like that's what we're doing. It looks like we're accelerating up. Weekly chart, daily chart, starting to get big bars late in the trend. The next reasonable stop entry trade, if you're selling below 59, you're simply looking for a test of the moving average, some profit taking. And then buying above 61 with this rally not particularly strong, I thought we might just go sideways here, and then we got the surprise on 67, 68. It became buy the close, and we just rallied up to the end of the day. For stop entries, I thought the first decent one, the first reasonable one was 30 or 34, and neither one was all that good. And then it's small pullback bull trend trading. You either buy below bars or you buy with stops. And if you're buying with stops, you're always buying higher up than you want. But that's the trade-off. Whenever you're taking a high probability trade, the risk is going to be big, and you usually have to be willing to scale in lower. Buy the close, sell the close. 14, 15, buy the close, and then maybe buy the close 36. And then 40, 41, buy the close again. And then again on 68, 69, 70, 71 by the close, and then again 74, 75, even 76 by the close. Limit order trading. The beginning of the day was interesting. The bears made money selling above 1. They made money selling above 4. They made money selling above 10, which usually reduces the chances of a bull trend. We went sideways for 3 hours. It was a weak rally, and the bears were making money. Even selling above 8, they made money. It pulled back below 8 and selling. So for the first 3 hours, it was fairly easy for both bulls and bears to make money. Yet once we started to break out, and once we started to get into a small pullback bull trend, sometime after 34, at some point, like bar 40, 41, you just have to stop selling. Maybe you get a rare sell above 54, below 59, but for the most part, I just can't sell because you're going to lose money. You cannot make money, and if it's impossible to make money selling, that usually means the market is going higher, and therefore you can buy for any reason at the market, below bars, above bars, buy closes. Usually the market will keep going up until it's fairly easy for the bears to make money. And it was not easy for them to make money here, and it was impossible for them to make money here. Limit orders, I would not take the sell above 2 or 4, above 10. I was looking to buy pullbacks, like halfway down bar 2, 50% pullback, or 50% pullback from the 10 low to the 11 high. But I was scalping, and then probably buyers below, well, obviously buyers below 15, less certain below 18. It's a low too short, maybe a wedge, 1, 2, 3. And then here, it was so tight that at some point in here, I didn't trade in here. And then going up here, small pullback bull trend, buyers below 41 for sure, probably buyers below 55. Probably buyers below 59, but I thought the bears might be able to get a stop entry short. And then here, looks like we might try to retrace spike pullback channel. Yeah, it's still favor the bulls, but we might go sideways and then down. 63, a double top, 59, but also possibly simply a pullback from the 61, 62 breakout. So I personally would not short below 63, but it scared a lot of bulls out. The bulls who were long, a lot of them got out below 63, and then they had to buy again, and it was not easy to buy again. You had to buy closes, 67, 68. And then we just rallied for the rest of the day. Really an absolutely incredible day. It turned out to be even stronger than that day from last week, even though it looked weaker through here. It finished stronger, and there we had a sell-off at the end of the day. Sideways the next day. On Monday, we will almost certainly get at least a couple hours of sideways trading, but we might get follow-through buying on the open. Strong finish, follow-through buying for a couple of hours before the market entered a trading range. It's also possible that we could collapse. It's so climactic, and there's a potential for news, with Mueller, but the chance of it is small. The odds are Monday will be sideways to up, and the odds are January is going to close at or very close to its high. There might be some profit taking, on Tuesday or Wednesday at the end of the month, but an absolutely incredible January. It's rare to get a January that looks like this, especially when the prior year was so strong. But there's no top, and traders are going to buy the first reversal. Okay, question. In your book, you talk about Two-legged pullbacks to the moving average are the best trades. Yet today, the question got cut off, but I'm sure he's saying today I was not eager to take the two-legged pullbacks, and he's right. Small pullback bull trends, when I'm buying, which I like to do, I'm usually buying below bars instead of above bars. But at some point in here, maybe here, but up here, we didn't even have two-legged pullbacks. We had a one-legged pullback here. You can call it a high two here, but that was a buy. And through here, no pullbacks to the moving average. Here, two legs down, one pullback two, or one pullback two. Okay, buy for a swing, but I thought the tight trading range would probably continue. So I don't remember what I did there. I know I didn't sell, and I'm pretty sure I did not buy. I waited for the breakout. But today's a very unusual day. You're only going to see a day like this every 2 or 3 months. But small pullback bull trend days that go from the open to the close, you get them about once or twice a month. But it turned out to be one of the strongest ones that we've had in many, many months. Okay, question, how many scalps do you take on an average day? Are you taking swing trades? What do you think is the most difficult thing for traders to transition from swing trading to scalping for higher probability? On a typical day, this question comes up every now and then, and I say on a typical day, I take 5 to 10 trades, 5 to 10 E-mini scalps. But I'm wrong every time I say that. For example, if I say, today I took 7 scalps, if I go back and count, I probably took 10 or 15. I always end up taking far more trades than what I remember. And swing trading, today would have been a good day for swing trading, but I prefer swing trading when there are strong breakouts and small pullback bull trends. I tend to scalp. Swing trading, I'm more interested in this kind of a thing for a swing trade. So buying in here, and holding for a swing up, or selling here and trying to hold part for a swing down. Because I like higher probability trades, and strong breakouts are high probability trades. Small pullback bull trend days never are as high probability as you want. And how can I possibly say that? Well, how often do you see a day that looks like this? Very infrequently, and that tells you that it's low probability trading, and it tells you all day long nothing is going to be all that high probability. And that's always the case with small pullback bull trends or small pullback bear trends. The setups just never look as good as you want them to be, and they always look like they're going to transition into a trading range. Yet the market just keeps going higher and higher and higher. So while the probability for the setups is not all that good, the reward is huge. But that's always the case. On a day when you have the potential for a huge reward, let's say you bought here and sold here, you have huge reward, but if you took that same entry on 5 other days, you would not get anything like that. So the probability is not high. And that's true for all kinds of strong trend days. Trend days that last all day are always low probability. Yet that's what happens whenever you have a huge reward, or whenever you have low probability. If you're trading it for a swing, you're holding for a huge reward, or you're taking this kind of a thing where you have huge risk but very high probability. You cannot get all three. You cannot get low risk, high reward, and high probability. I personally prefer high probability and high reward, even if the risk is big. I personally don't like high reward with low probability. And when that's the case, I usually look for limit order scalps, and usually I'm only trading in the direction of the trend. I just keep buying. Good question. You said that 31 and 60 are low probability. 60, that's right. 60 we're starting to convert into a trading range. Okay, it's interesting. I got half the question at one point, and then there's another question, and then the other half of the question later. But at this point, bar 60, that is a low probability bet. We have a spike channel and a lot of doji bars, a lot of small bars. Chances are we're going to go sideways. But I talked about how you often get bear traps in small pullback bull trend days, and then you get trend resumption. When you get trend resumption, it usually just goes up 4 or 5 bars, and that's it. It's really unusual for it to go up, 15 points like this or 14 points like this. This is really, really unusual. So something that's unusual is low probability. And the same with that other pullback over here. At this instant, it's a low probability trade. A lot of bear bars. We're testing the 20 low. If we break below the 20 low, we're probably coming down here. This is not high enough probability for a stop entry scalp. Trading range, 2 big bear bars. The bulls will probably want a micro double bottom. But an okay swing. We're still always in long, and we have a double bottom breakout test. Okay. A lot of the bulls want a micro double bottom, down, up, down. Does not look like a micro double bottom, but that's all that the bulls got. And buying at this point, not high probability. Still not. Okay, now it's high probability that we're going up at least a little bit more, that we'll get at least a second leg up. We have a bull breakout, a good sized bull breakout, and a bull follow through bar. So the odds are we're going at least a little higher. Really fascinating day. I would not worry too much about it. I did not take anything here, and I just don't worry about it because I like certain types of trades. I like high probability trades. I like very strong breakouts like the ones that I showed. And when I see situations like that, we had the bear version of it also the other day. But here, when I see stuff like that, I just sell at the market and expect at least a measured move down based upon the size of the body of the breakout. At a minimum, that would be the target. And the opposite is true with that kind of a strong bull breakout. I almost always get long, and when I see those big bear breakouts, I almost always get short and try to swing at least part. But for me, I don't like this type of trading. The math is good. You can always put up a higher time frame chart and ignore the 5-minute small pullback bull trend. For example, a 15-minute chart. Put up a 30-minute chart. Even then, it doesn't. It's by the close, but not all that strong. So it's not even particularly dramatic on the higher time frame. 60-minute chart, doji bull. Well, gap up doji, bull bar doji, and then bull ball. So all through here, it's not, particularly strong, bad follow through, but it just kept going up. I used to feel bad years ago if I didn't take all the trades. And now, if I take trades, there's certain types. Everybody has favorite setups, favorite types of trades, and by favorite, there's an implication of happiness. And when I see favorite types of setups, I'm happy. I like taking them. And then if I see trades that I think could be huge rewards, but the probability is low, I don't like to buy and hold, even though the math is okay. I tend to just scalp, thinking that the risk of a trading range is great, and the chance of one of these huge days is small. So on these huge days, if I simply, bought bar 4 or bought bar 2 and held, you'd make 23 points or something like that. And instead I just take pieces all the way up and I end up making less than 23 points. But, you got to find a way of trading that suits your personality. On most days, my style of trading works really well, and I'm happy to do it. But about once or twice a month, you get a day like this where another style of trading works better, the low probability, buy and hold, and just hope that you get the huge swing. Both are okay, but you got to do what makes you feel comfortable. Okay, this is really extreme. I think it increases the risk of, let me just take a look at the VIX, the VXX. Let me put up on a 5-minute chart. Okay, you got something's funny here, right? Here you have a huge bull trend with very little pullback. Very little pullback means very little volatility. Yeah, the VIX is down 11 cents, the VXX. Here's a 2-hour chart. And, it's near the high of the past couple of weeks. So that's telling us that traders are expecting increased volatility. Volatility means swings up and down, bigger pullbacks. So we're not getting them, but the VIX, instead of falling as the market goes up in a small pullback bull trend, the VIX looks like it's working higher, and that makes me think that there's an increased risk of a crazy 2 or 3 bear days coming up in the next couple of weeks. Why will it happen? Will it happen because of Trump and Mueller? Who knows? Right? The reason why it's going to happen is because the market is just up too far, too fast. And when it starts to correct, everyone who bought the past few days will be quickly losing positions, and they'll sell. Also, from an options point of view, options are cheap. Puts are cheap. Whenever puts are cheap, that tells you that you get what you pay for. If you're paying something not very, very much, you're probably not buying very much. And the options selling firms, they make their living by selling options. If they can only get people to buy puts by charging a very low price for the puts, then if the market starts to go down, they made very little money selling those puts, and these puts are quickly becoming profitable. Those option selling firms have to do something to hedge their losses, because as the market goes down, the delta will quickly increase from 0.5, 0.6, 0.7, 0.8, may get very close to 1. The result is the option selling firms have exponentially growing losses compared to the drop in the stock market, which, let's say, is linear, right? However you plot the stock market fall, the delta of the puts is going to increase exponentially relative to the fall in the stock market. And therefore, the option selling firms are going to be rapidly getting losses. Their losses are going to be increasing much faster than the stock market is falling. And they have to hedge. And the easiest way for them to do that is to sell stock index futures. And the result is the sell-off can go twice as far and twice as fast because the option firms have to hedge. And at the end of the day, you'll say, wow, the stock market fell 70 points today. That's very bearish. Well, it's bearish, but probably half of that 70 points is not from bearishness. It's from option selling firms having to hedge, having to sell stocks and futures to protect their position on their short puts. So therefore, the market can easily sell off 100 points and quickly reverse up to a new high a few days later. And that's probably what's going to happen. We're probably, the VIX is telling us that something is not right. The VIX should be really, really low when you have a very tight bull channel and a rally to a new high. Yet the VIX is above its low, and it's holding. Therefore, the odds are we're going to get some crazy days coming up. Okay, hope everybody has a good weekend.